はい。
Hi, can you hear me?
I can now.
Okay, sorry about that. Okay, let me start from 1.1 to 1.4 and then we'll get going on the next question. So this exam paper from November 2016 is covering concepts from the audit report as well as the income statement. And it's the November 2016 paper from the Department of Education. So I'm working through the first part just to warm up our minds a bit on concepts. So let's start with 3.1.1, which is interest on bank overdraft. Now, bank overdraft is a facility that allows us to use money that is not ours. It's linked to our bank account, but it's like a credit facility that is given to us. How the bank makes money in this is by charging us interest. So you would say that interest on a bank overdraft can easily be confirmed to be an expense called interest expense, okay? Then the next item is consumable stores on hand. Well, consumable stores on hand, there's two ways it can be reflected, either in the income statement or on the balance sheet. Now, because they specifically mentioned it's on hand, that means it's sitting in our warehouse, okay? Now, if it's sitting in our warehouse, that means that it cannot be used as yet. And only when consumable stores is used does it go as an expense in the income statement. Okay, so what that means is that we're going to classify it as an asset. Now, what you call it, the asset is consumable stores on hand asset, but that's not an option given to us. So the next thing we can look for is what type of category does this asset fall in? And the only closest option is current asset. Remember, consumable stores is generally used up within 12 months. That's why it's a current asset. Then we go on to 3.1.3. The portion of a loan to be paid during the next financial year is regarded as what in the balance sheet? Now, let's take the example I have on the page there. Let's say we have a loan of 100,000. Now, because we have to pay it, it means we owe money and it's a liability. Now, let's say 20,000 Rand of that liability is due in the next 12 months. That means the remaining 80,000 Rand will only be paid after the next financial year. That's after 12 months. So the 20,000 that we're going to pay in the next 12 months will be classified as current liability, because the definition of current liability is something that is payable in the next 12 months. The remaining 80,000 will be classified as non-current because it will be paid after 12 months. And finally, the difference between current assets and current liabilities is known as. So current assets and current liabilities, the common term there is current. Current implies within 12 months for our purposes. So current asset is basically an asset that can be converted into cash within 12 months or is already cash. So think about a positive bank account that's already cash. But then think about trading stock that can be sold quickly and converted to cash within 12 months. So that would be classified as a current asset. A current liability similar to trade and other payables, it's generally your creditors that you can pay within 12 months. Now, if we look at the available options that we can put here for this answer, you had cash and cash equivalents. Well, that's a type of current asset. It's not the difference between current assets and current liabilities. The other options we have is non-current asset, non-current liability. Well, just by the word non-current, you can eliminate it because we are dealing with current. And then income, well, that deals with the income statement. So we can eliminate that because that doesn't deal with assets or liabilities. The last option we left with is net working capital. And that is the definition of current assets minus current liabilities. In other terms, net working capital is the current assets you have left over after covering your current liabilities. Okay, let's move on from that. So now we are going to be working on a question that deals with the audit report. The audit report, you are provided with an extract from the audit report of Ferrelesi Limited. Now, if you will remember, when something ends in LTD, this means it's a, I'm just going to write it here, it's a public company. Okay. If something is PTY Ltd, that is a private company. So a public company will just be Ltd. Now, why is that important to know? Because a public company is required to be audited. That's very important. So what is an audit? An audit, you can have two items. You can have internal audit or external audit. So let's just write that here. You can have internal audit or external audit. So internal audit, most companies have, whether you're a private company or public company or partnership. An internal audit has people that are employed by the company. So let's take an example as ShopRite. ShopRite would have staff that they have employed in an internal audit division. The purpose of the internal audit and the team members in that function is to audit the internal operations of the company to identify areas of risk. So for example, they will identify areas of risk in employees committing fraud in the finance department, or a machinery breaking down and not being maintained. So any type of risk that can be linked to ShopRite, the function of internal audit is to test the company, its operations and processes to identify risk, and then they recommend suggestions on how to avoid that risk. So let's say the internal audit, for example, says that one person controls authorizing salaries for the staff and making the payment for them. So a staff in ShopRite who does that can pay themselves R1 million and then go and execute on it. Can you see the risk there of fraud? The internal audit function will come and say, okay, this is not right. One person should be doing the salary amounts and authorizing it, and another person doing the payments. So then that's their suggestion. Okay, that's the internal audit function. Now with external audit, these are people that are not employed in the company. They work for an external company, and you'll hear probably common names like Deloitte, Ernst & Young, PwC. These are external auditors. Now, the requirement for external auditors is to come to a company, they charge a fee, and then they audit the financial statements to assess the reasonability of the financial statements, to say these financial statements, they, based on our assessments, they look like they are free from error and that stakeholders can rely on them. Remember, we have investors out in the public. We have SARS, who is a tax authority. They all may look at our financial statements for a company like ShopRite, but how do they know that they can rely on what is written in those numbers? Is it accurate? Is it complete? So the external auditor comes and assesses the financial statements and gives their opinion through something called an audit report, to tell the shareholders and other stakeholders, yes, you can rely on these financial statements. No, you can't, because there's an issue and there's a concern we have. Okay, so that's just a bit of a background. let's go into reading the extract. So this is an extract from their report that I just mentioned. It says, we have examined the financial statements set out on pages 11 to 29. In our opinion, the annual financial statements present fairly in all material respects. So material respects mean in all important aspects of the report. The financial position of Relezi Limited and 30 June, so that's our balance sheet. The cash flow for the year ended, so that's our cash flow statement, in accordance with international financial reporting standards and as required by the Companies Act of South Africa. So basically, the auditors use the international accounting standards and the legislation in South Africa as a standard at which the financial statements must be compared to. So are they in compliance with these aspects? And then they sign off at the bottom, Rue and Peterson, which is the auditing firm. They are chartered accountants. So in order to be able to audit, you need to be a registered chartered accountant. Okay, so let's go to the questions. To whom is the audit report addressed to? Well, remember the audit report is included in the financial statements. It's a report that people can read. And who will want to use this report? Well, ask yourself who uses the financial information. And it is the shareholders, okay? So it's the shareholders that will rely on the report. Question 2, who has to ensure that the financial statements are prepared and presented at the annual general meeting? So recall, an annual general meeting is a meeting between management and shareholders once a year in order to discuss what has happened to the company in the year, to vote on important matters, okay? So this is the time where also the shareholders will come and review the financial statements. So who prepares it? Whose responsibility it is? It is management's responsibility. So let's think about that. Management is responsible for preparing the information. Shareholders come to an AGM, which is an annual general meeting. They appoint management to manage the company on their behalf. So management have a duty on behalf of shareholders to manage the company correctly. So in this case, management therefore has a responsibility also to report to shareholders at the annual general meeting on the financial performance of the company during the year that has passed. Okay. Then it says, choose the correct word from those in brackets. Write the answer next to question number 3.2.3 and explain your choice. Okay, so let's go to the answer booklet to see what they've basically said. So here's the options that we have in brackets. Relezi Limited received, remember they get this report from the auditors, AON qualified, unqualified, or disclaimer of opinion audit report, and explain your choice. Okay. So basically, what is those three terms? Well, when auditors provide their opinion on the financial statements, their opinion can be classified as qualified, unqualified, or disclaimer of opinion. Okay. Now, in this case, it is an unqualified report. Okay. So I'll explain what is an unqualified report. But for your purposes, an unqualified report is the best type of report to get from an auditor. An unqualified report, the key words you're going to look for in the report to show that it's unqualified is that they present fairly in all material respects. So basically, an unqualified report from the auditor is a report that says that the auditors have not picked up any issues in the financial statements. Everything is representing quite fairly in all material aspects or not. Okay, so that's the best report that you can get. The worst report that you can get is a qualified report. I'm going to highlight that in red. A qualified report is they've picked up a major issue. Maybe let's give you an example. Let's say the company Pick and Pay owns a property and they say that this property is used for meetings. But when the auditors come there, they say, no, the property is not used for meetings. It's actually used by the CEO as a holiday home. So you can see that the property is misrepresented in the financial statements as a land and building for the company, but it's actually been personally used for the CEO. So that would result in a qualified opinion. So basically the auditors will say, you know what, we've assessed the financial statements, but in respect to this material aspect, specifically with this asset, there is a major concern. Okay. So then that leaves us with a disclaimer of opinion. What is a disclaimer of opinion? Well, a disclaimer of opinion is when the auditors cannot give you an opinion. They can't tell you if it's qualified or unqualified. They said, you know, we've done all the work we can, but we can't give you an opinion. Why wouldn't an auditor be able to give you an opinion? Let's say it's now SPA. The auditors have gone to SPA and they've asked SPA management, please give me access to your systems so I can look at the numbers. SPA management says, no, you can't have access. Well, that actually prevents the auditors from auditing the financial statements and the numbers, etc. So they can't complete their jobs. They can't provide an opinion whether it's good or bad financial statements. So then they will issue a disclaimer of opinion if the management refuse completely. Okay. Let's move on to 3.2.4. Explain why the independent. Now, why do we call these auditors independent? Because they are not employed by us. Another word for external auditors is independent auditors. Because they are not employed by the company, they are basically outsourced. You go to the company and you ask them to provide you the service, the auditors, which is the independent or external auditors. But they do not work for the company. They do not get a salary for the company, by the company. Okay. Explain why the independent auditors referred to pages 11 to 29 in the report. Okay. So the auditor said we've examined financial statements set out on pages 11 to 29. So why would the auditors specifically mention those pages in the report? Let me explain to you what an report can include. A report will include a statement from management. It will include your financial statements, which is your balance sheet, your income statement, your cash flows. It will include the notes to the financial statements. It will include information on software issues. Let's say when I say software, it means not numbers. It will include issues on staff, on the environment, on development, on basically governance. Governance is on management. Basically, who are the management? Who are the directors? Their biographies, what qualifications they have, okay? So what I'm trying to prove to you that is the report, and this is not the audit report. Remember, this is the report produced by management. It's called the integrated report, okay? It includes just more than the financial statements. It includes a lot of things. The auditors are only responsible for the notes to the financial statements and the notes to the financial statements. Everything else they haven't looked at. So if there's something in the development section that's incorrect, you can't go to the auditors and say, well, you're supposed to have picked up that issue. No, They are specifically telling you they have examined only the financial statements on page 11 to 29. So if their opinion says that everything is good, it's only for pages 11 to 29. Everything else, there is no assurance that it'll be correct or not. Okay, so that's very important for you to know how to interpret what you can rely on more strongly than others. So if I was a shareholder, I will have more confidence on pages 11 to 29 because it has been audited versus the other pages in the financial statements, because that's just information produced by management. It hasn't been looked at by an independent auditor. Okay, so in this part, you basically had to say why the independent audits referred to those pages. Well, they were only responsible for auditing those pages. They are not accountable for any information in the other pages. Okay, so one of those two would have given you the full 2 marks. Quite a good question, covering concepts and audit report. Let's now jump into the main part of today's lesson, which is the income statement. Income statement, very popular question in exams. You are provided with information relating to Freelesi Limited for the financial year ended 30th June. Simple required, complete the income statement. But the marks is a lot, 60 marks. Here you're given some figures that we're going to chat through. So you're given figures extracted from the pre-adjustment trial balance. Very, very important. Pre-adjustment means that the numbers below have not taken account any adjustments as yet. It's very important. If this was called post-adjustment, if it was a post-adjustment trial balance, then it means then these numbers would have already included the adjustments in it. You wouldn't have not gone to do any adjustments to the numbers below. Okay. So under the balance sheet section, we have a mortgage loan, we have a bank. It says it's favorable. That means it's an asset. If it was unfavorable, it would have been a liability. It would be bank overdraft. We have debtors control, we have trading stock, and we have provision for bad debts. Sometimes provision from bad debts is subtracted from the debtors control balance. It's not put separately. So you need to look in your adjusted trial balance whether it's subtracted from debtors control or it'll be put separately. Okay. Under nominal account section, we have sales. Can you see it's less allowances already? Sometimes they put allowances separately, so you still then need to go subtract it from sales. Cost of sales, we have to calculate. We have directors' fees, salaries and wages, sundry expenses, depreciation, audit fees, repairs, rent income, interest income, we still have to calculate. We have bad debts recovered, packing material, advertising, loss of computer due to theft, and ordinary share dividends. Okay, so I have a 3-step process that I tackle with my income statement question. It makes sure that I complete everything and I do not forget anything. So the first part is I will take all the numbers that's related to the income statement, and that will sit under the nominal account section. And we'll discuss ordinary share dividends just now. And I will go put it in my answer booklet. And we're going to do it together, but I'm just explaining the 3-step process. I'll put it next to each line item in brackets. Step 2, I will then go and do the adjustments and put them in brackets next to the line items affected. And step 3, I will close my brackets and total. Okay. We'll do that process quite now. But before you start anything, before you do anything, please take a pen or a pencil. Highlight the nominal account section because that's all our income statement line items. But for ordinary share dividends, I want you to take a nice dark color and eliminate it. Ordinary share dividends falls under the nominal account section. But remember, ordinary share dividends is dividends paid to shareholders. Any transaction that deals with shareholders does not come in your income statement. So let me repeat that. Any transaction with shareholders is not in your income statement. So therefore, even though it's in the nominal account section, we're going to scratch it out because it doesn't go in our income statement. Trust me, as a student, if I forgot to do that, it's so easy in my 3-step process to just copy that number in and you would lose. They would actually subtract a mark if you put that in. For anything that you put in your income statement that is not meant to be there, they will subtract a maximum of 2 marks. Okay? Oh, that's negative marking. Another thing is if you do not show workings, they will subtract 2 marks at a minimum. Okay? So please be aware of that. Okay, so let's go do step 1 of the process. Let's just go put these numbers in. So I'm going to start with sales. I'm going to jump between the question and so sales. We will start with the amount of 4,777,300. Okay. Now what I'm doing is I'm highlighting the amounts that I've put in my account in a nice color. Let's put a purple. And why I do this, when as a student, you need to be quite systematic, follow a process. It makes sure you do the question calmly, completely, okay? Cost of sales, there's nothing. So I'm going to leave that. Director's fees, 375,000. If you went to the question, in the booklet, they put it here. So I'm just going to put it there in brackets. Okay. Highlighted. Salaries and wages, 365,540. It's highlighted, it's going in. Sundry expenses, we don't know. Okay, depreciation, well, that's an expense. So we're going to put that in the expense. They didn't put it in here for us. So we're going to just type. Okay. Okay. Audit fees, 23,000. And then we'll slot in repairs of 100,000. It's 2 numbers to remember quite easily. Okay. Rent income. Okay, this is an income now, 101,900. So we're going to move away from our operating expense section. We're going to go under other income. We're going to put rent income. Interest income, we don't know. Bad debts recovered, that is a type of income, okay? So a part of knowing where to put items is to basically know your elements. So what do I mean by elements? Elements is basically asset, liability, income, and expense. And if you know these amounts, you know what falls under each category, then you'll be able to easily put them around in a question. A key thing you must know, a question is not there for you to sit and think in terms of what's an asset, what's a liability. You need to do all this preparation out of the exam. You need to just know bad debts recovered is an income. And how are you going to do this? And I'll give you 2 tips. Practice a lot. You'll get more comfortable with the numbers and the terms and where they fall. And secondly, take a bit of theory and study it each morning. 10 minutes in the morning, 10 minutes at lunch, 10 minutes at supper. Doing small steps of studying consistently over a long period of time is better than cramming over a week. Okay. Packing material, 13,600. And then we got advertising, which is also an expense of 20,596. So we're going to go under operating expenses. So remember, because packing material here is shown under the nominal account section, we can safely assume it's an expense. Okay. If it was shown under the balance sheet section, then we would say it's an asset. Okay, so knowing that difference between nominal and balance sheet is also very important. Okay, we're almost through with step 1. 9,300 loss. A loss is an expense. Okay. And that was 9,300. Now, what I should have done is I should have highlighted that also in black, because when you're running down the numbers in the exam, that can throw you off. Okay, so can you see how nice it is? Now I know 1, 2, 3 items are missing and I still have to get to them. Okay, this is step 1. Step 1 shouldn't take you much time as it did with me. I was just typing it on the computer. Now let's do step 2. Step 2 is also a process I work as I go through the adjustments. Okay. A credit note for 35,700 issued to a debtor, dated 27 June 2016. The date is very important because every transaction that falls within the financial year will be in the income statement. Anything that falls out of the financial year, it must not be in the income statement. It was not recorded. The cost price of these goods was 21,000. The goods were placed back in stock. So what happened is a debtor returned some stock to us and we issued them a credit note, basically saying that we reduced the amount that they owe us by 35,700. So by issuing a credit note, what we must do is think about the original transaction. It's a very easy way to think about what do you do the adjustment in the income statement. When you originally made the sale, you would have debited debtors control and credited sales. Now, when you are reversing it, you're going to debit sales, credit debtors control. And what do we know when we debit sales? We have to subtract. So we're going to subtract 35,700. Okay. Now what I do is, once I've done a transaction, I also tend to tick it off in the side. Okay. Just as, okay, I've done it. The business prices its goods at a markup of 70% on cost. Trade discount of 297,200 was allowed on invoices to certain customers. Okay, so remember trade discount is subtracted from sales. The way the information was presented to us in this scenario basically showed that sales was less of those allowances. So whatever the sales amount was, let's say, sorry, let me go up again. What's going on? There we go. Okay, there we go. Let's say we call sales X. We don't know what sales is. Then we know that the trade discount was 297,500. And then after we subtracted that amount, we got the 477,300. Happy? Okay. So what are we going to do to calculate cost of sales is we're going to use the markup. It's 70% on cost. Let's go to a, so first let's calculate here. We're going to need sales. And if you calculate that, it should give you, if you just add that up, okay? 4,741,600. So cost of sales will be the sales amount, 4,741,600. But remember, when we do a markup, we do it on total sales. So we must now add back that trade discount of 297,200. So let's go back to the question. Remember, where they gave us a markup, but they said trade discount of 297 was allowed. So when we are using sales in the markup formula, we need the sales amount before the allowances. So because to calculate the sales after the allowance, we subtracted the allowance amount. To get the sales amount before allowance, we are going to add back the 297,200. And let's see what that gives us. 4,741,600 plus 297,200. That's 503. 503,800. And what I did is, and I'm going to show you the calculation here, is I divided it by 1.7. So how did I get that 1.7? Okay, let me show you that. I'm going to put it in the top here. So the question said, we go back to the marker, that the price of goods is on 70% on cost. So gross profit is 70%. Okay. %70 on cost. So that is on cost. So let's take an example. Let's take a simple example. And I'm just trying to drive the point home. If you have a cost of 100 Rand, gross profit will be what of that? It'll be 70% of 100. And that will give you 70. And what is selling price going to be? Selling price is gross profit plus cost of sales. Other words said, if you take sales minus cost of sales, you get gross profit. So if you add gross profit to cost of sales, just going to move this a bit. There you go. It will give you selling price. And in my example, if gross profit is 70, cost of sales is 100, selling price will be 170. Okay. Now, why did I use this random example? And I'm going to tell you to do this when you're given a ratio. Always take a sort of what if scenario in your mind to make more sense of what the ratio means. Okay. If cost is 100, and I just took a random, I like to work with 100 or 10 because it's a round number and it's easy to get other numbers from it. So what am I doing with this arbitrary numbers is I'm going to use these numbers to do a new ratio because I want to calculate cost of sales from my sales number. Remember, I do not have gross profit and I do not have cost of sales. I can only use sales and to calculate cost of sales. Okay. Now, if you using the ratio above and using the relationship I just explained, sales, cost of sales as a percentage of sales will be 100 divided by 170. Cost of sales divided by sales. That is a ratio you must use. Now, if you multiply that by our actual cost of our actual sales amount, if you go back to the scenario, it was 503,800. Then that will give you cost of sales. Okay, so what I've done is I've used the relationship between cost of sales and sales to apply it to my sales number to calculate cost of sales. Now, if you know, sorry, it will be, wait, this thing's just not moving. There we go. It will be, sorry, 1 divided by. Okay. Okay. Sorry, my laptop's acting up a bit. Let me move it a bit. It will be okay, my laptop's a bit slow, but it'll be 100 over 170. And because we are calculating, it'll be 1 over 538,800. So let's just think about that. Cost of sales is 100 on the top. The 1 represents the machine cost of sales number. 170 is the part of the ratio that relates to sales. And 503,880 is our actual sales. So just going to bring up a whiteboard quickly to put that in much clearer because that PDF is not working properly. So let's recall, if cost is 100, gross profit okay, should see my whiteboard in front of you. So if cost is 100, gross profit is 70. Sales, which is going to be the sum of both, 170. So if we take a ratio of cost divided by sales, based on this ratio here, it will be 100 divided by 170 equals, and let's bring it back to the numbers of the scenario. The numerator is cost of sales. We don't know what cost of sales is. We're trying to calculate, so we're going to call it X. It'll be X divided by what is sales? For us, it was 50388. Oh, just check that number. 100. Okay. So 100 is cost of sales divided by 170. That is based on the ratio given to us in the scenario, right? Then I've translated that ratio to represent the numbers in our trial balance. X is what we're solving for, which is cost of sales. Sales, we know we've totaled that amount of 538,800. So how do you now solve for X? Well, X, which is, remember, our cost of sales, will equal to and this is just pure maths. X will be the multiplication of 503,800 times 170 over 100 which is basically 50388 multiplied by 1.7. Aha, there's that 1.7 that I've come to. Okay, so that's how you get that 1.7. So let's go back to scenario. Okay. So we've taken the total amount of sales, the 474,600. We added back the allowance of 297,200 to give us total sales. If you add those two numbers, you'll get 533,800. And we divide it by 1.7 to give us a cost of sales. And remember, we have to put it in brackets because cost of sales is an expense, 2,964,000. Please show the right direction, incomes in positive, expenses as negative. From that, by taking sales minus cost of sales, you can calculate gross profit of 177,600. Okay. So this was step 3. I've totaled. Now, the reason I've totaled is because based on the information, the scenario, they had to make us to calculate the total sales amount to get to cost of sales, and then we can get gross profit. So that was a combination of then step 2. Now, because sales and cost of sales are done with, I'm going to step 3, which is I do the final totaling in the final column. Okay. Now let's move on to the next one. Adjust the provision for bad debts of debtors to 4%. Okay, 4% of what? Well, bad debts is basically a provision. It's an estimate of what percentage of your debtors will go bad. It's an estimate. It's not the actual bad debtors. It's not the actual customers that have gone bad. It is an estimate based on past experience. What percentage of the people owe you money will go bad? So the question said it must be 4% of the balance of here, of debtors control. So let's go to our scenario. Do we have a current bad debts expense amount? Let's go back and see if we have. We have bad debts recovered. Look here. Under the balance sheet section, we have a provision for bad debts balance of 3,732. Now that is basically something I call a negative asset. Because why? It's an amount that will reduce your debtors control. Remember previously I said it can be netted off against debtors control. It can be subtracted here under debtors control and put as one line item. So that's why I call it a negative asset. You subtract it from another asset. So the current balance is 3732. Okay. Let me open up my white screen again. $3,732. So that's our current amount. $3,732. The new amount must be 4% of debtors. So what is our debtors amount? Let me switch back to the question. Our debtors control balance was 116,500 before adjustments. If you recall that an amount affecting debtors control was not recorded, a credit note of 35,700. Okay, so 35,700 we return back to a debtor. So it must be subtracted from that 116,500. So let's go back to our whiteboard. So 116,500 is our debtors balance from our trial balance before adjustments. We must subtract the 35,700 because remember, when we reverse a sale, we will debit sales, we'll credit debtors. By crediting debtors, we decrease it. And let's see what that's going to give us. So it's 116,500 minus 35,700. That's 80,800. And now what is 4% of that? $3,232. Let me just check if that's what the calculator is giving me. 3,232. So our provision for bad debts balance must be 3,232, but currently it's 37. So it must be reduced to 3,232. And that's a 500 reduction. Now, how do you reduce the provision for bad debts? Well, it acts opposite to a normal asset. Remember, I called it a negative asset. So it acts opposite to a negative asset. An asset increases on the debit side, a provision for bad debt increases on the debit side. So an asset increase on the debit side, but a provision for bad debts, which is a negative asset, opposite to an asset, will increase on the credit side. So now if we are decreasing provision for bad debts, think about the journal entry. We are going to debit provision for bad debts by 500. Okay. And then we are going to credit provision for bad, I'll just bring this up a bit more. Bad debts adjustment, which is the one that goes in your income statement for 500. So the part that ends with the word adjustment is the part that goes in the income statement. The other one, provision for bad debts, is your balance sheet item, a line item. So always be careful of the wording for this. The one that has adjustment to it goes in your income statement, but the other one that doesn't have the word adjustment to it is a balance sheet item. Now, because we are crediting it, a credit item is an income. So let's go back to our question. So we are going to go here and we're going to say provision for bad debts adjustment under other income of 500. Okay, you can say the calculation, because remember we get penalized if we don't show it. There we go. I'm going to do step 3 for this because it's the only item and it's going to be a 500. Let's move on to our next adjustment. So we're done with B, we're done with C. Almost there. D, stock counts on 30 June reveal the following on hand. Trading stock of 2,500, packing material of 3,700. Let's go with trading stock. We have in our warehouse 225,500. But in our balance sheet, our trading stock is 209,500. So we have 209,500 before adjustments. Remember that. If you recall, there was some stock that was returned to us of 21,000. So that 21,000 we must go add to the trading stock pre-adjusted amount. Okay. So let's do it here quickly. 209,500 plus 21,000. And what will that give you? Bring up a calculator. 209,500 plus 21,000. 230,500. Okay, so that's the new balance after you've done for the adjustments. Now, based on what's in our warehouse of 225,500, we have less in our warehouse versus what's in our books. So that means that maybe something is happening in our books. We need to now go reduce the amount in our books. And how do you reduce an amount in your books? Well, you are going to credit inventory by reducing it, and you are going to debit something called trading stock deficit. And because you're debiting it, it's going to be an expense. So under, wrong section. Under operating expenses, we are going to put trading stock deficit. And the amount is going to be the 209,500, which is the original pre-adjusted inventory balance, plus the 21,000 stock that was returned, minus this physical amount in our store. And I'm going to finish step 2 and put the answer in step 3 because it's a final transaction. And that amount will give me 5,000 Rand. Now, how do you know it's a trading stock deficit? Is because the amount, and this is sort of the rule you need to follow. Let me just put it here. Here's the rule. If you look on the right-hand side corner of the screen, if stock on hand is greater than stock in your books, then you're going to have a trading stock surplus, which will be basically an income in your income statement. If the stock on hand that's in your warehouse is less than what is in your books, that means you need, remember, your books must always match what's in your store, because you can't match what's in your store to your books. Your books are just numbers you've done. You need to show that your books must show what's in your store. So if you have to now, if your store is less than what's in your books, you need to reduce the amount in your books. So that's going to be a trading stock deficit, and that goes in as an expense. Okay. Okay, so we've done trading stock, now packing material. Now, packing material, if you go back to the balance sheet section, there is no packing material asset. What that means is if you go to your nominal account section, there's a packing material expense of 13,600. Remember, something is expensed only when it has been used. That means you've incurred the expense. That's the accounting term. But if we have amount of 3,700 still sitting in our warehouse, then that means that not all the amount that we put as an expense is actually an expense. Some portion of it is an asset. So what are you going to do? You're going to recognize an asset and you're going to have to reduce the expense by crediting it for the 3,700. This is completely different to what we did with trading stock. We didn't compare an asset in our books to what's in our warehouse. Now we're saying, okay, we see we have amount in our warehouse, but what is in our books? Our books has everything expensed, and that is wrong. It can only be expensed if it's not in our warehouse, it's been used. So we have to take 3,700 out of our expense and put it as an asset. And how do we take it out of our expense? We are going to credit the expense. So we're going to go to packing material. I'm going to minus 3,700. Just go back to that. Okay. Let's see how we're doing so far. Okay, part D, excellent, done. E, external auditors are owed a further, that's the key word, further, okay, 7250. So what are you going to do? And I love thinking about journal entries because it makes my life so much easier. You're going to debit audit fees expense because that means you used more of their services if you owe them more money. So 7250. And then you're going to credit a liability. Now, I don't know what's the name of the liability, but because you owe them the amount, you're going to credit a liability. Now, you're debiting an expense, which means you need to go increase an expense by 7250. Well, we already have an audit fee expense. So what we're going to do is we're going to just add to it 7250. Great. Nice, simple, to the point. If you know your journal entries, you will know that one. Okay. Interest on loan is capitalized and has not been recorded. The loan statement from Paris Bank on 30th June reflected a closing balance of 372,920. Okay, let's go see what's in our balance sheet. Okay, so we have a mortgage loan here of 33200, but in our statement that we get from the bank, it says it's 372,920. It increased. Okay, now this is a challenge. What can happen to our loan during the year? We can take out more loans, which will increase if you take out more. Or you can pay your loan, which will decrease the loan. Or you can be charged interest, which will increase your loan. Because remember, the loan is capitalized. What does capitalized mean? If interest is capitalized, it means it's added to the loan liability. It doesn't have its own separate liability. It's added to the loan liability. Okay, that's what capitalized means. So that's why if you have interest charge, it will increase the liability. Now, of these things, if a loan increase, that doesn't affect income statement. If you pay off your loan, that doesn't affect income statement. But the interest expense charge that you have will impact the income statement. Now, there are three things that can impact the movement from the pre-adjusted trial balance to this amount of 372,920. Do we have amounts for any increases or decreases? No. So we have more than one unknown number. So we can't calculate interest expense. So what we're going to do is when you stuck with this situation exam, move on. I'm not going to tick it. I'm going to move on. Okay. Corrections must be made in respect of a computer that was stolen on March 31st, 2016. The bookkeeper completed the following page in the fixed asset register using the incorrect method of depreciation. Well, this impacts income statement, doesn't it? So let's see what happened. So we had something at cost of 42,000. It was bought in 2014. There's the depreciation, nothing in 2014. At the end of 2015, for the first year, we charged depreciation of 8,400. And there's 33,600. And then 31st March, that is when the computer was stolen. We charged depreciation of 6,300. And then that's 27,300. Then the insurance paid us 18,000. And then based on what the book value is, minus our insurance payout, we calculated a loss of the computer of 9,300, which we saw was sitting in our income statement. Okay. So depreciation on this asset should have been calculated at 20% per annum on the diminishing balance method. Okay. So what is the diminishing balance method? It's you apply the depreciation rate to carrying amount. Okay. So for the first year of depreciation for the 8,400, you would have applied it to the whole 42,000 because it was the first year we bought the asset. So cost will be carrying amount. So this 8,400 is correct, even though it was based on cost, but because it's the first year, cost is the same thing as carrying amount, so it's fine. Now the second year, the issue comes. We need to actually calculate depreciation, and I'm typing it out here as, if you take the opening carrying value for the second year, it will be the 33,600. Remember, closing balance of a previous year is opening balance of the current year. So you take the 33,600 and you multiply it by 20%. And what should that give you? Let's pull out our calculator. 6,720. And we recognize depreciation of 6,300. So we need to increase depreciation by the difference. So let's go to depreciation. So I'm going to do this like this. I'm going to take out the incorrect amount of 6,300. And I'm going to add the correct amount. And what's the correct amount? 6,720. Okay. Now, that's not the only thing that would have been impacted in our income statement. Remember, the loss of computer will also be impacted because the carrying amount at the end of the year is now, let's take this out. It's not 27,300. It will be the carrying amount from last year of 33,600 minus the new depreciation of 6,720. Okay. And that should give you, let's see. What's the carrying amount? 33,600. That should give you 26,880. And when you take that 26,880, go down, you take the carrying amount, 26,880 minus 18,000, which is the amount we got for from the insurer, 8,880 is our new loss on the computer. Remember, we're still making a loss because we are getting paid less from the insurance versus the carrying value on the date that the computer got stolen. The carrying value is 26,800, but the insurance paid us 18,000. So they didn't compensate us for the full value of the computer. So we still got a loss of 8,880. So you're going to have to adjust that loss. So let's just have a look there again. We have a depreciation amount. Whoa. Let's step back a bit. There's something going on. Okay. What did I forget? I calculated a full depreciation for the year. But what is our financial year? Let's go back a bit. Go right to the start. It's 30th June. So this computer got stolen before the end of the year. So can I go calculate depreciation on the full 6720? No. What must you do? You must apportion it. If it got stolen in March, that means that it got stolen 9 months into the year. So we only had it for 9 months in the year before it got stolen. So we need to go multiply that depreciation by 9 out of 12. And what will that give us? So we're going to take the 6720 times 9 over 12. Oh, sorry, 6720 times 9 over 5,040. Wow. Just by not picking up that we disposed of, it got stolen before the end of the year. So we can only depreciate it for the period we had it, which is 9 out of 12 months. So our depreciation here, we mustn't add 6720, we must add 504. Great stuff. Okay. Now let's go see what that will impact now in terms of our calculation for our loss. And here's it on the right-hand corner. So if we take out our depreciation for the year 5040 from our carrying amount of 33,600, we left with a new carrying amount of 28,560. 28,560. Okay. If we subtract that 28,560 is what our asset is worth versus how much we got, then our new, so let's do that quickly. Our new loss is actually even greater. It's 10,560. Okay. So our total loss in the final column must be 10,560. So you can do this two ways. You can subtract the 9,300. You can add the 10,560, or you can just do the difference between them. Okay. I like to take out what's wrong and put back what's right. Okay. Let's move on. Put a tick here. I think we've got about 2 more to 3. Well, the third one's not really, but okay. Monthly rent did not change during the year. During April 2016, the tenant paid 6,000 Rand for repairs to the premises. He deducted this from rent for May 2016 as repairs are the responsibility of the company. The repairs was not recorded. Okay. So basically what they went and did is our rental income we earned for May month was 6,000 Rand less, because what the person did is they said, okay, we're going to fix it. We'll just take the money from repairs. But for our records, our rental income must still be that amount, including the 6,000. So we are going to increase our rental income by the 6,000. Because for us, we need to recognize a new expense called repairs for 6,000. Yeah. Okay. Regardless of who pays it and how we reimburse the tenant, that has nothing to do or impact in accounting record. The fact is a repairs expense was incurred. The rental income, the full amount is still must be recognized as rental income, because that's the nature of the income. Okay, so that was the first part. The second part is the rent for July 2016 was received and deposited. Oh no. So July 2016 falls out of our current year because our current year ends in June. So what does that mean? That this total rent income is for 11 months. Okay. So what is that income? So basically, you take your calculator, you say 101,900 plus the 6,000. You'll get a total income of 107,900. Just adding those two numbers together. But that is for how many months? 13 months. 12 months of the current year plus July of next year. So that's rental income for 13 months. Let's switch to our whiteboard. So let's recall what's that amount. It's 107,900 rent income for 13 months. So we need to take out that amount because it's not income earned for the current financial year. So let's calculate our monthly amount. So we divide it by 13. And that gives you 8,300. So we need to now go remove that because it's income, it's basically paid in advance. It's received in advance, right? The journal entry should have been debit bank, credit, income received in advance, which is a liability. What we went and did, we credited revenue. So to decrease now, we have not revenue, we credited rent income. So what must we do? We must decrease rent income by 8,300. Okay, that had two adjustments. So we're done with H. I, advertising consists of a monthly contract with a local newspaper for the entire financial year. Advertising was paid for 11 months only. From April 2016, the contract rate decreased by 152 Rand per month. Ooh, okay. This is a very, very popular adjustment. Now, if you go watch any of my other videos on this, I tackle this more in depth and the different options specifically with rent and insurance and show you how to mathematically calculate it. But let's go do it here. So we have an advertising expense in our income statement. Let's go through that. Of 20596. 20596. It's for 11 months. On 1st April 2016, the contract rate was decreased by 152. Okay, let's go through our whiteboard. Okay. So 1st April 2016, just recall that information. Contract rate decreased by 152 per month. Okay, great. Remember, our year starts okay, that's our year. Sorry, 16. We have recognized for 11 months expense, which is equal to, let me just get the amount quickly. 205.96. Okay. Okay, should see the whiteboard again up. Okay, so the issue is we need to calculate the additional months amount that we need to recognize. So if we say July, August, September, October, November, December, January, February, March. 9 months. 9 months. The salary would have been, let's call it X. We don't know what it is. Okay. March, April, May. April to May is the remaining 2 months we've recognized. It would have been the original rent minus the 152 per month. Okay. And that gives you the 11 months total of 205.96. So I write this in terms of a formula. 9 months times the normal rent amount plus 2 months times the rent amount minus 152, decrease each month, will give me 205.96. So if you solve that, that becomes 11x of normal rent plus a reduction of, let's do this quickly, 152 times 2 of 304. I'm just opening the brackets there. So minus 304 equals 205.96. And all I'm going to do is solve for x. So 11x equals, you take it over, it will become 304 plus 205.96. That is 20,900. You divide both sides by x, or 11. And each month, remember x represents each month, it would have been 1,900 for advertising. So we now need to do for the missing month. The missing month is June. Now remember, June is the month after the decrease happened. So the missing month will be the normal salary minus 152. Sorry, not salary, the normal amount. So it'll be 1,900 minus 152, which will give you 1,748. Okay, so let's switch back to our solution. We're going to go to advertising, and we're going to add. Great. Okay, almost there. So let's tick that off. Nice one. Very common. This comes up very often. And if you follow my sort of maths formula way of thinking about it, you shouldn't go wrong. Net profit after tax is 504,000. Okay, they were nice enough to put that in the solution for us right at the bottom. Use the following percentages to calculate certain missing figures. Operating profit on sales is 15%. Okay, here's operating profit. So it's 15% times, what is our sales amount? 474,1,600. And you should get, it's a positive number, it's profit, 711,240. Okay. Let's look at the next ratio. Income tax rate is 28% of net profit. Okay. Now we are given net profit after tax. So let me do this on the left-hand side here, you'll see. Profit before tax is X. If we multiply that by 28%, by 1 minus 28%, this is the after tax rate, we will get 504,000 because that's the after tax amount. So to calculate X, all you do is you'd say 504,000 divided by 1 minus 0.28, which is 0.72. Okay. So here, net profit before tax is going to be 504,000 divided by 0.72, and 0.72 is just 1 minus the tax rate. And you should get 700,000. And you can simply say now 700,000, either multiply by 28% to get the income tax of the year, or you can simply subtract 700,000 from the 504,000, because the only thing that takes it from 700 to 504,000 is income tax, and you'll get 196,000. Okay. So let's tick off this information. We've used that, we've used that, we used that. Now, we've done with part 2. We've worked through the adjustments, but wait a minute. There was still one adjustment missing, interest expense, part F, right? Let's go to our trial balance. Have we completed cost of sales? Yes. Sundry expenses? Interest income? Okay, I'm saying that because maybe not. Let's go now have a look at what's going on to our income statement. Now we are going to work backwards here, okay? Let's start from the top first. Okay, we have our sales, we have our cost of sales, we have gross income. Let's go do step 3 and total the rest now. So rent income is going to be 99,600. Bad debts recovered of 10,540. We show it as in this big dark block, all positive, and because it's other income, we're going to total it up above, and it will be 110,640. Let's go to operating expenses. Directors' wages. We're still going to show it as positive, even though it's an expense, because it's in this bracket. It's in this dark block. Then we're going to show 365,540. Okay. Sundry expenses, we don't know. Okay, depreciation. 123,000. Audit fees. 30,250. Repairs. Oh, so we had a repairs amount. So I put it in the bottom here. So let me go delete that. 6,000. And I'm going to add the 6,000 here. So repairs is going to be 106,000. Packing material is 9,900. Advertising is 22344. 2 to 3, 4, 4. Then we got the 10, 5, 6, and 5,000. Okay. What else can we do? Okay, we're going to come back to that. Let's go complete here. Gross profit plus other income. We can get a subtotal here of 1,888,240. Okay. So we have done the top part, our expenses. We have sundry expenses missing. We have operating profit. Aha. We know that this total of 1,888,240 minus our expenses will give us operating profit. So we work backwards and we say 1,888,240 minus the operating profit of 711,240. It will give us our total operating expense amount in brackets of 1,177,000. Okay. Now, if we have our total operating expenses, we have all other expenses except sundry, we can work backwards by taking all the other expenses and subtracting it from the total, and you'll get a sundry expense of 129,406. Okay, so this is just mainly a numerical exercise. Okay, so let's go back to our trial balance now. We've calculated sundry expenses. Interest income is missing and interest expense. Okay, now you're kind of stuck here, right? Because you need either interest income or interest expense. So let's go back and have a look at that interest expense note and let's see if we can make something of it. Interest on the loan is capitalized and has not been recorded during the year. The loan statement from Paris Bank reflected a closing balance of 3,729,20. Okay, 3,729,20. But what is the amount in our balance sheet? 333,200. Okay, let's write it here. Okay. So that is a difference of 37200 920 minus 333,200 is 39,720. Okay. So remember I said that there's many movements that can take the balance of 333,200 to the amount in the statement of 372,920. So that's why I left this adjustment, because maybe there was payments, maybe you raised more loan from Paris Bank. So we don't know that the total difference is from interest only. But I've worked through all the other adjustments. There was no additional information on the loan, firstly. Secondly, if you look at the income statement, there's no way I can get to this amount by doing any other adding and subtracting. So I can safely assume that the increase from the pre-adjusted amount to the final statement balance is all from interest. And that, remember, that amount was 39720. So interest expense, I'm going to put it in brackets here, 39720. Now you're going to say, well, I would have just done that anyway. I would have just taken the movement from the start. Well, you could have, but what if the scenario had given you later on information that you paid back a portion of the loan, or you raised an additional loan? Because interest expense doesn't only increase the balance, raising more loan from Paris Bank would have increased that balance. So that is why I left it, because there was some uncertainty there. I couldn't say 100% certain that that increase was all attributable to interest expense. I worked through everything. I did all my other numbers. I didn't stress my mind out. I didn't start panicking at this uncertainty. I went on. I did everything. And then I come and I sit here and I say, okay, I have this increase. I have no other way, no other ratio, nothing to calculate interest expense. So I can safely assume now that that increase is only to interest expense. And then I put it in. Okay. And then now I can work backwards. Okay. Now I've got an interest expense. Okay, let's go calculate profit before interest expense. Work backwards from the bottom up. And you'll see it's 739,720. And then interest income, well, you got a number operating profit and profit before interest expense. The difference, if you work backwards, will give you interest income of 28,480. Remember, you didn't have anything that gave you information interest income. So now I can tick off F and I can tick off interest income. I've dealt with it. So that's the income statement done. But you see, I follow a very systematic approach to answering it. And I just think a little deeper on something in terms of if something is uncertain, move forward. Don't stress yourself. Do it. Somehow or the other, you will come to a conclusion on that uncertain item. Okay, so I hope my approach has been helpful. These are typical adjustments. I mean, this paper is 2016, and if you pull out a 2021 paper, you'll see very similar questions and adjustments coming through for income statement. I hope it has been useful to you, and you can catch our next lessons that we will cover other topical issues in accounting. Thank you.